Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at SchnellInvestor, and you can also find my blogs on gregschnell.com as well as StockCharts.com. So this week we've seen some huge moves in the bond market. Last week I think the 5-year bond yield moved 50%, more than 50%. So it was crazy big. So I want to talk about what that means for the overall market, and we're going to cover that off with respect to the Fed meeting coming up today in the bonds. And the big moves that it started in the bonds, and can the financials continue to rally? So that's the focus of the message today. And just to make sure everybody knows, the new website at gregschnell.com is now open, and I have a second chartered market technician on the site with me, and his name is Dwight Galusha. And so you're more than welcome to come over there and check out lots of free stuff we have, and we'll be adding more all the time. But it's there for you to use, and hopefully there's some good stuff for you. For any of you that are looking for some subscription service, these are all the different things I offer for my members that come onto the site and pay the subscription. So not pressing you to do that in any way, just to let you know. So lots of good things over there, and hopefully you'll find it pretty interesting. I get lots of nice compliments, so hopefully there's something there for you. Moving on to the high yield. So I'm just going to go through. I have a chart list that I work through for my members every week, and I covered these bonds off last week, but I think they're quite compelling, and I want to talk about the story specifically. So these are all weekly charts that we're going to roll through. Some will be monthly, some will be weekly, but I'm trying not to get into the weeds on the daily. And you can see that we have literally been making higher highs and higher lows on the high yield market. What that means is that bonds that were expected to default are actually performing better now and coming back. And I have called this unadjusted, and by putting the hyphen in front here, that changes the chart to be unadjusted. What does that mean? Well, we actually back out the yield payment that you would have gotten from owning this ETF, and this only looks at the price action. And so it cleans it up, because what you find is as the price moves down really extreme, all of a sudden the yields pop up, and so it can change the chart shape quite significantly. So if we just look at the price without the yields being added back in, this gives us a little cleaner look. So far, at the end of Tuesday trading, we've seen that this is pulled back slightly, but look at the huge moves we've had over the last couple of weeks. It's been unbelievably big. Now, going into the 7 to 10 year bond, and I'm going to start just with this high yield in the 7 to 10 year just as a ratio, and we'll talk about why I do that. But what we see on this chart was that we were accelerating higher when we broke through a really big, meaningful top from 2016. And as we moved here, I noted back in late December that the market was moving above the 10-week moving average, and all of a sudden off it went and shot up. And last week it crossed down, and we're finally getting, I'll call it, a topping structure at this point on the bond. This is a bond ETF, so it's the bond price. So as the price rises, the yield gets smaller, and as the price falls, the yield goes up. So what we see here is that this is losing strength on the RSI. So what we have is the RSI is making a lower high as price is making a higher high. I don't want to make a big deal of that. I think more importantly, what's happening here is that with the Fed taking control of the debt market to make sure that we don't have a lot of companies declare bankruptcy all at the same time, and try and make sure that companies that could have made it through without COVID probably have the chance to still do that. So they've been very aggressive and ahead of the curve. And one of the things that we know from history is that when the Fed is involved in the market, it's bullish, and it's very bullish, and you want to stay on the right side of that trade. So what we see now is that the 7 to 10 year bond price is falling, mostly because the the risk has come off the table in the bond market, and so now people are moving out of that and moving into equities, and we still see that today. So I know the equities have had a big rally, but all of my work says that there is so much liquidity, and at this point, everything is still trending higher. So while the market might have pulled back on Tuesday, after 10 days of running up, the market can pull back 1 or 2 days a week and still be in an uptrend for the most part. So to have the first day in 9 that the market pulls back the day before the Fed, who'd be surprised? But anyway, we have a big move going on here, and so what we're watching for in the bond market is we want to continue to see the bond market, I'll call it, slow down in terms of price and rise up in terms of yield while money moves out of bonds and into, I'll call it, more risk on developments like equities. And again, that first chart I posted was the high yield. And what was happening there was it was continuing to go higher. A little tick down so far this week, but I'm sure if we get the right news out of the Fed later in the day, we'll see a big move or a continued move up in bond yields and down in price, and I think the equity market will continue to rally into the next month here. So what we see on this is the high yield compared to the 7 to 10 year. And when this is rising, this is pretty bullish. Now it's coming up to the bottom of the 40-week moving average, and I would like to see this finally get above that. That's a much more bullish picture, and it did that in 2016. In 2017 and 18, it stayed sideways, so nothing really terrible. But since the big market drop, you might remember the fourth quarter of 2018, this ratio fell below the longer term average, and it has continued to stay below. So I want to see as this comes up here that we actually get back on the top side, and this starts to outperform as we go forward. Now looking in on LQD, this is the corporate bonds. So the last one was the 7 to 10 year government bond, and the one before that was corporate junk bonds. So what this one is, corporate bonds, and the Fed has told us they're going to support the corporate bond market to make sure that they don't have trouble with liquidity. And so this has been rising up. Now, I particularly like this chart, and it's good that people are invested in the corporate bond market. That's a good thing. One of the things I've got here, Paul Tudor Jones said this is the next place for trouble to show up. And literally right after he said that, because it was starting to break to new 5-year lows, off this thing went on a rally. And we got some support out of the Fed changing interest rate policy and whatever. So this rallied up. Then we had the COVID dip, valley, V, spike, whatever we want to call it. And then we pulled back up to the top here. And at the top, now we're sitting here saying, as long as it's up in this positive territory, I think we're fine. What I would like to see is that the PPO trend line here breaks this and just goes back up and continues to wobble at a high level. That would be a better choice for us. I'm not going to cover the tip bonds this week just because they've gold and the tips have followed pretty closely. So gold line is the price of gold and the tips is in front here, and basically they've been following each other. So we're just going to leave that one for now. This is the 20-year ETF for bonds generally. So if you wanted to buy a long bond ETF, TLT has been outperforming and recently rolled over at the end of April and is making lower highs and lower lows. And as long as that's the case, this is still in now what we'd call a downtrend on the short-term basis, because you can see on the on the longer term basis, it's been in a big uptrend. And the idea to watch here is what is the big trend in the bonds. And so I'll show you something in a second here on the 30-year bond, and it looks to me like it's rolling over, and that's for a long time. But we're early, like we're weeks into this thing, and I just want to show the difference in the charts as we go forward. So this big uptrend here is something to be watchful of. If this started to break down, that's really people selling bonds and moving aggressively into the rest of the market. So as this starts to approach the 150 level on the TLT, I'm really excited to watch and make sure that the bull market we're in continues and that this does actually break this big uptrend. Now again, this is unadjusted, so I've taken the yield off, and if I add the yield back in, the chart changes quite a bit. But you can see there's still the same kind of information is there. It's just not as clean. And this, if you owned it, you would get a dividend payment every period. So the idea behind taking that out and just looking at the raw price action is so you don't get a distortion. But in this case, it's still pretty clear that we are in an uptrend. Okay. Let's get into, whoops, because I changed that chart. That's not what I wanted. Sorry about that. Let's go here. Now, one more. Okay, and so here we're going to jump into the 30-year bond price. And one of the things that's happened on this chart, so this goes back roughly 10 years, and what you see is we made a new high on this bond price. And then as we did it, we basically chopped around. So even all through this whole COVID exercise, we had the big move in January, February, and then roughly, here we are, call it March 1st, we spiked up. And so that was just as the COVID thing was hitting. And we haven't done much since, but last week we really started to break down. And it was actually, I'll call it early May, that we were testing these lows, and then a brief rally, and then it's fallen for 2 or 3 weeks here. It's been quite straight down. This is a weekly chart. It's only midweek, so now what we need to watch for is what the direction on this is. One of my other indicators that I'm about to show, which is the PPO over a long period, this indicator got up to a really high level, and I want to show you, just looking not just over 20 years but over 40 or 50 years, what that means. And so on the PPO, it's a percentage price oscillator, and so we can compare times back in history for how extended it got, and then we can also compare just the level of extremes, whereas we can't do that with the MACD, because the higher the price goes, you'll see that the higher the waves go. So we have a lot more waves kind of really blowing out, making it look like huge extremes, whereas these waves on the PPO, while they're at the top of the range, they aren't as extreme. So that's kind of one of the reasons I like to look at this chart from this perspective. And I'm just going to change this to 40, and hopefully that'll straighten out my little box here. Yeah, it did. Okay, so the perspective that I want to show you, first of all, is that bond prices have been in a giant uptrend. They recently broke below that, and I want to say in 2018, and then they rallied back up and they got to the top of the channel. While they made a new high, they haven't broken outside this big channel. So we do have the makings here for a potential for a major trend change. So we threatened to go lower, we tried to go higher, and we couldn't get back. So far, we're not quite back to the top of the channel. But what we really want to watch for now is, does this make a meaningful pull down? And does it actually start to break through the bottom? And we don't know that yet, but without question, we were at a huge extreme. We were up near 4%, and you can see that we've had 3 others here, and this one was a huge pullback. This one, the extreme was here, and then we pulled down and made a slightly higher high with lower momentum. That is not what appears to be setting up to me. And then over here, we went from the bottom all the way up to the top, and when we got to the top, price wobbled sideways while momentum weakened. And now what we're seeing is, we had a sudden surge up with COVID, and now we're rolling over. But I think the more important thing to be aware of is, so far we haven't pushed outside this channel, even though, or to the top of the channel, even though this data suggests being at an extreme. So one of the things I'm wondering is the top in, and I think It is. And this big rollover in bond price is going to start pushing up bond yields. And by doing that, that will help the government or the Fed because they want to get away from this zero treasury where interest rates start to go negative. So this is one of the things they're going to encourage is that bond prices start to rise, I think. So as we see this, this is the same the same bond, but now we're looking on the yield side. So these will go up as the bond price falls. What we see here is this really took a big surge last week, and it was huge. But more importantly, it broke out of this base that we had built, and now this week we're checking back a little bit. But you can see that this PPO was way down in very deep territory, and unlike what we saw on the bond price, and again this yield keeps winding lower, but it was the sudden percentage move, and because as we get closer, the same 10-point move in the bond yield down here compared to back up here is a much bigger percentage move. So from 20 to 10 is a 50% move, whereas from 60 to 50 would only be like a 20% move. So we see these big extremes on the percentage price oscillator. And because of that percentage change, this has made really record swings. And this big push back up is pretty important, and we want to see that continue. We want to see it get through the 40-week moving average, and that if that should happen, I think that's really going to help support the financial sector, and it's going to make owning these financial stocks a lot better. So zooming in on that last chart, this was that big wave down on the PPO. You can see that when this happened, we were all set up and monitoring it on my charts on gregschnell.com. But if this rolls over under zero, this is a big question based on where the yield curve is. Well, it literally slammed down, and that was one of the clues that we started to have some big change. So we want to watch how this behaves, and you can see that it's pushed up pretty nicely. But coming out of the Fed meeting, it's one of the biggest implications on these charts. So we want to keep watching it. And if you just took a yearly look at the bond price, again, back to the price, the last chart was the yield, but you can just see we continue to climb here. Now we still have 6 months left to see where this final data point is. But so far we are really breaking out. I'm going to move on to the 10-year chart now. And what happens on the 10 years, you can see we had this big move down, then we've had the QE intervention, and the market wobbled. I'm trying to get that to zoom in. The market wobbled twice here and now has shot up. And it's this big move up, and this was big. These big changes are really trying to force the bottom to be in and start to turn back higher. And if that's the case, that should be bullish for financials, and one of the reasons that the financial stocks started to rally. So on the 10-year weekly bond yield, what we see here is we finally got the PPO cross last week, and it's starting to turn up. And now what we want to watch for after the Fed meeting is, does this continue to move higher? And obviously that's what the government, or what the bond market, what the Fed would like with the bond market, is to normalize the yields back well above zero. And this is 0.6%, 0.8%, and the 10 level is a 1.0. So we almost got to 1.0% last week, but we've come down from 3%. So this is still a 70% drop here. So we've got lots of room to move up just to get back to where we were in 2019. Okay, I'm going to speed it up a little bit. So here's the 5-year. And what we saw last week was the 5-year yield soared. And this move from here to here was 50%, 55%. Like, it was big. And so this to me looks like we're actually starting to build the bottom. Now we may wobble here this week with the Fed and then continue our climb. And that would be what we're looking for. And if that happens, then we want to start moving into the financials more aggressively, because they should have a tailwind behind them. So this is just the daily chart of the last 2 years for the 5-year. And you can see the big push up and then the pull back. So far this week. It's more important what the long end of the bond is, bond yield is doing, but we want to keep an eye on what the short end does too. So here's the 2-year daily, and it's pulled over too. So after everything pushed up, and as we come into this Fed meeting, good place to just kind of keep track of what's going on. When you're in a bear market, this will tend to stay below 60 on the RSI. You can see it stayed above 40 for years over here, and then now it stayed below 60. So this is an important inflection point. What we'd like to see is this gets back into a bond yield bull market and a bond price bear market. So it starts to roll over on price and higher on yield. Moving on to the 2-year, this chart here is the weekly, and you could just see pulling back a little, but it's also trying to make a big bottoming pattern here, and the dive was so severe that the PPO indicator still hasn't started to turn up yet, amazingly, but it's trying. And this bounce down here, again, we took out the 2011 lows, so now what we want to watch for is that this continues to rise. But I get the feeling that the big moves last week were starting to say, okay, these bond yields are going to start to move higher. So all of that gives us a chart like this when we watch the bond yields, and what we're seeing here is the 30-year bond yield starting to move up, the 10-year moving up, and yet the 5-year, 3, 2, and 1 were all kind of continuing down. As those spread apart, we end up measuring the distance between the two of these, so let's say the 30 minus the 10-year, and that tells us our spread. And as those spreads widen out, and one of the big ones to watch for is the 10 minus 2, is as those spreads widen out, that's good for banks because they loan on short term and borrow on long term. And so they can cover those spreads. So here's the 30 minus the 10-year. And what I've put on this chart was we see these big trends breaking. And when that breaks, we see the stock market usually correct pretty hard. So far we've corrected really hard, and the stock market has bounced back up. Now what we want to see is, can this yield continue to get up into this 10% level? And while it did that, you can see back here, even the stock market continued to rise up here. So the Fed has tried to shorten the cycle of trouble by picking up corporate debt and trying to ease us through this area. But if we can start to get the yield spread wide enough that the banks can make money, that's also going to help the banks lend more, which helps the economy restart. So that's one of the big things we're looking for. Okay. So I've covered off enough about the bonds, but they had a huge move last week, and so that makes it pretty influential for us this week. What I've got here is a list of banks and financials, and in this particular list, I've grouped them by their industry type. So here's the asset managers like BlackRock, and it's up at 88%. And if we hovered over here, you can see the chart's trying to break out to a new all-time high. And here's T. Rowe Price, affiliate State Street. These are common names. Invesco is just barely coming off the lows, whereas you can see BlackRock obviously quite a bit different. And here's Jefferies. This one's finally pushing up. So all of these charts are trying to make a base, but these ones still have very weak scooter rankings, and BlackRock is up at the 90% level. When we get into the actual banks, you can see we only have 3 banks with a scooter ranking above 75. Now, you might not be surprised by that, but that's not great. We'd obviously like that to be a much better level. So when we watch these charts, I'm just going to look here. Here's JP Morgan, and I'm going to click on this one. But the point I want to show you is here's the scooter ranking up at the top, and I've got a blue line at 75%. And when they get above 75%, they're in the top 25% of price action. Well, you can see JP Morgan is still at this point, still only better than 30% of the stock's price action. For one of the best banks in the world, that's pretty difficult. But we have got a PPO cross here, and now what we want to start to see is that this price continues to rise out of the hole, something like it did in 2016 or even back in 2009-10 period. But going back to this list, so I have a lot of banks here, and again, lots of them have very low scooter rankings. Some of them single digits. These are really hard hit. So we want to keep watching these banks as the bond yields change. And looking at the investment services group, so this is Morgan Stanley, Goldman Sachs, that type of thing. And here's Goldman. You can see shooting up nicely. I mean, look at the move just recently from 180 to 220, almost a 25% move in the last 2 to 3 weeks. And you see the same thing, Morgan Stanley really starting to take off. So there's been a big move here, and none of these charts are starting to roll over. Some of these charts are starting to roll over on a daily basis, but for the most part, the momentum is still higher, up, up, and away. And the biggest thing for us to focus on is making sure that as these charts start to accelerate away, that we, if you want to get back into them, they're now starting to make that base and move forward. So it's a pretty important place to pay attention to. Some of the other areas of the market that are doing okay, so here's Intercontinental Exchange and CBOE. The scooter ranking down here for CBOE is only 11. NASDAQ group here, we've got a scooter ranking of 86. So in this investment services area, there's 4 or 5 here that are doing quite well. I'll call it 70 and above. I like 75 and above, but Goldman's at 70. Anyway, you can just see that these 5 or 6 are still looking great and seem to be on their way. And lastly, a couple of specialty finance, Moody's and MSCI, have a high scooter ranking of 89%. So they're telling us that those are some of the best stocks in the area. What I'd like to do now is just quickly look at these on a candle glance view. And the idea being, when we format the charts like this, that we can just go in and look and see what the price action is showing us. And so here's the chart soaring to a new high. So this is just breaking out. What's wrong with that? Deutsche Bank has actually surged back up to its pre-February highs, or pre-COVID highs in February, and trying to test those right now. So we'll see if it's got enough price action to get through. Here's E-Trade Financial. Moody's is, remember, it had a very high scooter ranking. It's pushing up very nicely. So what you want to see in a stock is that the PPO gets back above zero and that positive momentum. And we can see on E-Trade, it has stayed in negative territory for a year and a half here. So that isn't the place I want to go looking, but I do want to see stocks that used to have PPOs at nice high levels turning back up and maybe buying into those as they start to move higher. So here's MSCI. I mentioned it was a pretty strong one, but here's UBS, and it doesn't have far to get through to make it to new 52-week highs. And again, if all of these banks can get through to some of these banks can get through to new 52-week highs, that's going to be very, very bullish for us, and really help us see that the transition that the Fed was trying to create by creating a floor under the debt markets is working, and we're starting to see the financials lift out of here. So here's the affiliate managers, Canadian Imperial. Again, just as we roll through this, you can see different chart shapes on all of these. There's no real group similarity. But what we need to watch for is the development of these charts and coming through the Fed meeting. And don't use one day, whatever it does on Wednesday afternoon, usually whipsaws on Thursday. But by Friday afternoon, we should start to have a direction figured out for these financials, and that would be an important thing to consider. So thank you for taking the time to join me on Market Buzz. Market Buzz airs Wednesdays at 10:30 a.m. Eastern. You can also see the recordings on StockCharts TV YouTube page, and don't forget to find my U.S. and Canadian market reviews on StockCharts YouTube as well. When you go there, I've got a big event showing up on Friday called The Pitch, and I'm going to be doing that show with Julius de Kempenaar, Tom Bowley, and Mary Ellen McGonigal. I'm looking forward to that. That should be very, very exciting. So try and dial in on that. That should be a wonderful event on StockCharts TV on Friday. So if you get the chance, check that out. Thanks again for joining me here on the Market Buzz, and have a good week. Try and stay positive. Everything is trending higher right now. Thanks, everybody. Bye-bye.
Give us a like down below. Leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.